Joining us now is David Bahnsen of the Bahnsen Group and Lori Calvasina of RBC Capital Markets. Guys, good afternoon. So, David, the Dow kissed 40K and then ran away. S&P's flat around 5,300. If you're a long-term investor looking to deploy capital, do you do it with an eye on the Fed, or do you wait until the market's not about watching the Fed anymore?
Well, you have to do it with individual investors' risk tolerance in mind because of timing risk and entry risk. Statistically, there's no question the better thing to do is to deploy sooner when you're talking about the Dow. The S&P being market cap weighted and being so top heavy, and just being very valuation conscious, I'm a little more hesitant to put capital into the index in that sense. The Dow tends to have more value-oriented names that doesn't have nearly the same valuation issue. 40,000 Dow, you're investing for 100,000 Dow. It's going to happen in the lifetimes of people that are in their 40s and 50s. It just is. But I think right now, in terms of timing and the Fed and certainly the multiples you're buying for the S&P, it could pay to be a little patient.
Okay. Well, Lori, your valuation work has been suggesting 5,200, 5,300 is fair value if core inflation falls to 2.5%. 10-year yields come down to 4. We get 1 to 2 cuts, you say. So what would it take to justify 5,400 from here, since we're sitting right at the top of that range?
All right, well, look, it's a great question. And look, I would say our valuation model, we always say it's a compass, not a GPS. It kind of gets you in the right neighborhood, not necessarily to the right street address. But generally, I would say that what we really need to see is greater than anticipated deceleration in inflation. Or perhaps you could also get greater than expected relief on the interest rate front. I'm a little bit more optimistic about the former than the latter. But generally, we found in the post-COVID environment, PE multiples are acting a lot like they did back in the 70s, which is that they're really taking their cues and acting very inversely correlated with inflation prints. So that's really the first thing that jumps to mind. Also, I think we can look at the economic forecasts. One of the things I've been talking to investors about today is how really it's going to be getting, time to start thinking about 2025 pretty soon, as hard as it is to believe. And economic forecasts, while they've really ratcheted up for 2024, they're still pretty sluggish for 2025, sitting at about 1.7%. So if we were to start to see optimism on 2025 really pick up, I think that could power stocks for this year as well.
David, I do want to get your thoughts on earnings and the role that earnings growth is going to play in this market as we are hovering right near record highs. I mean, look no further than Walmart. It finished the day up 7%, a big move for that name. It pushed consumer staples higher. It was the only sector in the S&P to actually finish today higher. And a key part of it wasn't just the beat on the quarter, but the fact that they raised their full year guidance one quarter in. We're seeing some of that among other sectors and other companies, and certainly among strategists who think that earnings growth is actually going to be stronger through the second half of the year. How do you see it?
Well, the problem is that so much of that is priced in. We're big holders of Walmart. We've been invested in it for over 15 years. And a 7% move in Walmart today came because it was not expected. The problem is that at 22 times forward earnings for the S&P, they're already expecting 11% earnings growth this year and 13% next year. And that it requires a revenue growth and a market multiple that, to me, is very priced for perfection. Walmart wasn't priced for perfection. A number of consumer staples names this quarter have not been priced for perfection. That, to me, is where investors are going to find better value.